On May 2, 2015, during the annual meeting of Berkshire Hathaway, Warren Buffett, one of the most successful investors in history, issued a crucial warning to investors and financial managers. Excessive complexity in the financial market can be a dangerous trap. His speech emphasized a principle that, despite seeming obvious, is often ignored. Simplicity can be one of the most powerful strategies for achieving long-term success. Buffett, alongside his longtime partner Charlie Munger, addressed a recurring theme in his investment philosophy: the importance of avoiding complicated strategies and sophisticated financial products that promise extraordinary gains but often conceal high risks. He contrasted this approach with his own investment philosophy based on simple and solid principles, such as buying companies with enduring competitive advantages and holding these investments for decades. This message becomes even more relevant in a scenario where investors, both amateur and professional, often find themselves seduced by sophisticated mathematical models, complex derivatives, and high-frequency strategies. He emphasized that, in many cases, these methods not only fail to deliver consistent returns, but also expose investors to significant losses. The context of this speech also deserves attention. In 2015, financial markets were still feeling the impacts of the 2008 crisis, caused largely by extremely complex and opaque financial practices, such as the trading of mortgage-backed securities. Warren, who had been advocating transparency and rationality in investments for decades, took the opportunity to reaffirm his commitment to simplicity as one of the greatest allies of the long-term investor. Furthermore, his speech can also be interpreted as an indirect criticism of Wall Street's behavior, where financial advisors frequently promote complex products and strategies that benefit intermediaries more than the investors themselves. Warren reminded that throughout history, investors who followed simple principles, such as buying quality stocks and holding them over time, achieved superior results compared to those who sought miraculous shortcuts to wealth. In a financial world where excess information and the pursuit of quick solutions can lead to hasty decisions, his warning is a valuable reminder. Investing doesn't have to be complicated, and often, the simpler, the better. Buffett's speech at the 2015 annual meeting of Berkshire Hathaway follows a characteristic pattern of his communication: clear language, concrete examples, and a focus on investor education. He reinforces the idea that simple strategies are more effective, debunking the notion that complexity and sophistication automatically result in better returns. Warren uses historical examples and statistics to demonstrate how simplified investments, such as index funds, tend to outperform active managers in the long run. He highlights that Wall Street often encourages complexity to justify high fees and commissions, but true wealth comes from patience and consistency, not from attempting to predict short-term market movements. Another relevant point in his speech is how he appeals to investor psychology. He emphasizes that impatience and the constant need to intervene can be enemies of wealth growth. Using a didactic tone, he compares the stock market to a baseball game where the investor is not required to swing at every pitch. Patience and careful investment selection are the keys to success. Warren's speech leads us to a broader reflection on how we make financial decisions. In a world flooded with information and sophisticated models, simplicity is often underestimated. However, the fundamental principles of sound financial management remain unchanged: diversification, patience, and consistency. Belief in simplicity in investing does not mean ignoring market analysis and study, but rather avoiding unnecessary complications. Many of the best investment opportunities lie in companies whose business models are easy to understand. As Buffett often emphasizes, investing in something you truly understand significantly increases the chances of making sound decisions. Furthermore, Simplicity in the financial market is not limited to investments, but also applies to personal budget management. Spending less than you earn, avoiding excessive debt, and maintaining a clear financial plan are actions that ensure stability and wealth growth in the long run. Finally, his message reinforces an essential point. The simpler the approach, the greater the chances of success. Avoiding trends, staying focused on the long term, and trusting in the compounding of investments are strategies that have stood the test of time and remain effective. Reflecting on Buffett's message, it becomes clear that simplicity is a powerful strategy, both in the world of investments and in everyday financial life. The warning against unnecessary complexity is not just a critique of the financial market, but a universal principle that can be applied to various areas. Warren teaches us that by avoiding the traps set by seemingly sophisticated solutions and focusing on the essentials, we achieve better results. Patience, discipline, and a true understanding of what we are doing are the real drivers of financial success. For investors of all levels, the lesson is clear. Trust in simplicity, focus on the long term, and avoid shortcuts that promise quick gains. As he wisely said, investing can be simple, but not necessarily easy. And it is precisely this distinction that separates successful investors from speculators. If this message resonated with you, share this knowledge with others. And remember that in both finance and life, simplicity may be the key to true success.